Hello, everyone, and welcome to Let's Talk Real Estate USA. Today we have Dina Parla of Guaranteed Rate Affinity, and we are talking something very simple. We are talking the different types of loans. We're talking conventional, FHA, VA, USDA, we're talking renos, and we're talking about how to buy your rates down. Remember to like and subscribe for more weekly content. Let's get going. Hello, everyone, and welcome to Let's Talk Real Estate USA. Today we have Dina Parla of Guaranteed Rate Affinity, and we are going to be talking the major types of loans. We're going to be talking conventional, FHA, VA, etc., etc. How's it going, Dina?
Going all right. Can't complain.
Wonderful. All right, let's get going. So, number one, we have the most common type, the conventional loan. So, can you tell us a little bit more about it, what we need when we apply for it, etc.?
So a conventional loan is the most traditional type of mortgage. Down payments can go as low as 3%. We have some first-time home buyer programs that allow for 3% down. Generally, minimum FICO of 620, although higher is always better. It's for that would be for a single family. For a multifamily, if you're going into a two-family, minimum down payment is 15%, and 3 to 4 is usually 20 to 25, depending on if you're going Fannie or Freddie for a conventional.
So what do people need when they apply for these mortgages?
Well, first and foremost, they need to fill out an application, right? And then the application will request, it will pull credit. Okay, so we need to see the person's credit. Documents we'll need 2 years of W-2s if they're a W-2 employee, 1 month of pay stubs, 2 months of bank statements or any statements that they plan to use for down payment and closing costs. If they happen to be self-employed, we'll need 2 years of tax returns.
Cool. So the next one we have is the FHA. And what is the FHA and what was it created for? What do we need?
So FHA is a government loan. It was created for people, maybe lower FICO individuals, people that might need a little bit more help from the government, I guess. And basically, minimum down payment for that is 3.5%. What's cool about FHA is that for multifamilies, up to 4 units, if the person is living in the place, obviously they have to live in the place because FHA is for people that are going to be occupying the residence. But yeah, no, it doesn't matter what unit, how many units the place is, 1 to 4, it's still the same down payment, 3.5%, which is nice. So a lot of people who are looking to buy, it could be somebody that's very well qualified that has an 800 credit score, but they're looking to buy a multifamily house. Instead of putting 15% down or 25% down on a conventional, they're doing an FHA for 3.5 down. So that's cool. Kind of like a cool thing about FHA.
So the third one we have is the VA loan. So what is that created for? What do you need to get it?
So VA loans are pretty cool. They're for our veterans. They are a no down payment loan, and they're really cool because there is no real set FICO score for them, and there's no set debt to income ratio, right? Where like conventional FHA, and then probably the next one we're going to talk about USDA, they have specific how much debt you're allowed to have versus your income. VA doesn't have any of that. Really, it's just, it doesn't mean that there's so many factors that go into a VA loan and whether a person qualifies for it. But, somebody can have I don't know, 550 credit score and still qualify for a VA loan with no down payment. So it's really geared toward helping our veterans out. And it's a great product.
Wonderful. So I will say the one thing that, like these VAs and certain ones with almost zero down payment, The only thing the people have to keep in mind as they go forward is that when you have zero down payment, many times the seller is going to walk by that, especially if it's a multi-offer scenario. Sorry, people want to see, and I've been told this multiple times, it's not that they don't believe that they're worthy. It's that to have absolutely no money down, they see as having no skin in the game, which is ironic. Like, they're soldiers, but no skin in the game. Okay. But like, I get it. Like, people want to see some sort of down payment.
Yeah, I mean, it's unfortunate because it doesn't mean that these people aren't qualified. They're just taking advantage of the resources that are there for them to buy a house. I mean, I think anybody would buy a house at no down payment if they could.
Yeah.
You know, so it's unfortunate that a lot of sellers are taught or, you know, have this assumption that they're not qualified. But yeah, I mean, I do find with the VA people that I have worked with, or like the no down payment loans, they usually have to give some sort of money up front, like, you know, like some sort of down payment to show that they do have some sort of skin in the game.
Mm-hmm. So let's talk about the USDA loan, which I've yet to encounter.
Okay. Well, yeah, I mean, based in your area and like where you target, it's probably not going to be that used that much. USDA loan is for rural areas in the state. So, you know, out in like Sussex County, if we're talking New Jersey, Sussex County out there, some parts of Passaic, like West Milford, you know, out west, or very far northwest. Yeah. But yeah, so that's another no down payment option. The USDA, the only one of the qualifications is it has to be in a rural area. So, you know, somebody who's looking for a house in that area, to find out if that particular place is a USDA approved place, they could just go on the USDA eligibility website and type in the address, and it'll say whether or not it's considered a USDA eligible property or not.
So then we come to the Reno loan. There's also a few other types of loans that kind of do the same thing. But the Reno loan, the whole point of it is that I had a client, they bought a place for like $300. It was a mess. When they fix it up, it'll be like $450. But the whole idea is they can get the money to build it up. So can you tell us more about the Reno loan?
Yeah, there's a few types of Reno loans, but basically it's for the property that needs some extra, whether they need some like extra work done to have it qualify for a traditional loan, right? An FHA or a conventional loan. Sometimes people need to get renovations to like fix something like that. Or sometimes it's just cosmetic. You know, so there's different types of renovation loans for that. There's renovations loans that you can go as little as $5,000 for a renovation. And usually that's just for like appliances or things like that. Or you can go for like a whole, like, you know, adding on, an addition or something, you know, major renovation, like doing like a whole kitchen and bathrooms and things like that. So there's a lot of different options for renovations. And renovation loans still follow the same traditional. If you're going conventional, it still has like the 3% down. If you're going FHA, it's 3.5% down. So there's nothing really that changes there. It's just,
so the Reno loan is connected to another one.
Well, it's one loan. Mm-hmm. It's one loan. But basically it's like if you're buying a house for $300,000 and it needs $100,000 work, you're buying it for $400,000. And then us, the lender, provide the money to the contractor. Like you don't get the money at the end to do the work that you want to do. It's very specific rules and things that you have to follow to get that scope. We need to know the scope of the work and approve the scope of the work to get that done.
Cool. Let's talk one more thing before we go. Let's talk the 2-1 buy down.
Ah, yes.
So
2-1 buy down.
Yeah. So what is the 2-1 buy down? Because now that interest rates are rising, people are all trying to figure out ways to lower their interest rates. Yeah. So what is the 2-1 buy down?
So there's a couple buy downs. There's the 1 buy down. There's the 1 and 1.5 buy down, and then there's the 2-1 buy down. I'm just going to talk about the 2-1 buy down just because they're all kind of similar. But basically, it is a way for the buyer to have a lower interest rate for the first 2 years of the mortgage. So let's just say hypothetically, the par rate, today's rate is 7%. If they do the 2-1 buy down, their first year is going to be 2% lower, so it's going to be 5%. The second year is going to be 1% lower, so it's going to be 6%. So over the course of the first 2 years, they're saving tons of money monthly, annually, on this particular loan product. And the hope is that by the third year they can refi. Hopefully the rates go down, but that's not always the case. So you got to keep that in mind.
Cool.
Now, nothing is for free, right? So how do we pay for these 2-1 buy downs? So the cost of the 2-1 buy down can only come two ways. The borrower cannot pay for it. It's got to come from a seller concession. So they bump the purchase price, and they ask the seller, for the cost of that buy down, or the lender can increase the rate, right? Like let's say, and give them a lender credit. So let's say me bumping the rate to 7.625 is going to give them the funds they need, the lender credit they need to buy the 2-1 buy down. So now instead of that 7%, now they're getting 7.625%. But still, they're getting 2% less the first year, so 5.625.
And then 6. All right. Well, I believe that's all the different types of loans we were going to talk about today. So thank you very much, Dina, for coming on again. This is your second time on.
No problem. Thanks for having me.
Wonderful. All right. Thank you, Dina, and have a great day.
Care.